I like to say the only thing worse than 2 and 20 is 100 and 0, meaning you lose all your money, you don't pay carry, but you're direct on captive.
I'm not saying fees aren't important. Of course, fees are important, but look at the quality of the team you're working with, the people you hire. Saving a few $1,000s on some fees to get a worse investment, to your point, I don't think that's a good trade.
Michel, Andreessen Horowitz just raised a $15 billion fund, and the principals decided to start a family office. Why do that?
Families and the principals in general have evolved to a point where they require and deserve institutional quality asset management and attention.
There's hundreds of options out there, single family offices, multifamily offices. Every large bank pretty much has a family office. There's OCIOs. Why specifically start your own family office?
To address the specific needs of founders who have a very specific fact set, concentrated stock, a desire to build something greater than themselves, and so on and so forth. So there's a lot of details that we feel could be done more specifically, I don't want to say better necessarily, but more specifically for founders.
Most people in the family office world are from previously wealth managers or family offices. You come from the endowment world. What were your first principles when you built out A16Z Perennial?
Well, it was all about let's bring best practices of asset management, high quality asset management, like is what is done in the endowment world, to individuals. So it's all about everything from how you structure things to fee and tax efficiency to minimizing the total headwinds you get from sort of the traditional fund-to-funds approach.
And this is very strategic for Andreessen Horowitz in that you run it on a break-even basis. What does that mean?
Well, it means that this is really, we put our money where our mouth is, as people like to say. This is a strategic endeavor to build a community.
Just taking a step back, we have some of the top IPOs coming up in the future, 3 of the largest IPOs. There's many founders that now have significant stock positions. What should founders be looking at in terms of planning for these kind of liquidity events?
Boy, I mean, there's everything from the trust and estate setup. If you're a U.S. taxpayer, I know not everyone here is necessarily a U.S. taxpayer, but if you're a U.S. taxpayer, a lot of trust and estate setup, to what I would call how do you intelligently liquidate stock, which generally involves having a derivatives capability in-house, to how do you redeploy intelligently in a way that helps you at least somewhat diversify your, what I would call your growth equity risk factor.
And I previously talked to your real estate partner. You guys have really focused on building out your real estate part of the business. Why build a real estate asset management when you have venture capital as its core?
Well, first of all, it's a great diversifier, right? Real estate is probably not very correlated to venture, so that's a nice thing. But two, real estate's obviously one of the oldest asset classes, so like everything from the tax code to the ability to lever these assets is beneficial to individuals. So you can really structure something that is very powerful in terms of generating great after-tax cash flow, some inflation protection, and then of course correlation again to the aforementioned equity factor risk.
I think one of the most interesting trends and topics in asset management in general is this rise of the taxable investor. The former CEO of iCapital, Lawrence Calcano, he talked about these tens of trillions of dollars from retail coming into the institutional space and to asset management space. And the second order effects of that is that now products are being built for the taxable investor. So maybe you could double click on why a taxable investor would want a different product than an institutional investor.
No, it's a great point. Taxable investing is a lot harder than non-taxable. I used to work in the endowment world where everything was non-taxable. And so the problem is a lot easier, right? Because you don't have to worry about short-term gains, long-term gains, the character of gains, where the gains come from even matters, right? Certain geographies are off limits. And there's a lot of value you can generate from how you structure things. So just using the real estate example again, as an example, the traditional real estate GPs, their carry crystallizes when they sell the asset, right? If you're a taxable investor, you don't like selling an asset because that's a taxable gain event, right? You'd rather hold the asset, depreciate it to zero value over its 25 to 30-year depreciable life. You'd like to tax-free cash out refi it along the way. So it's a very different holding period and a very different way to compensate the professionals you work with. So from the very foundation, the way you approach it is completely different.
You probably said two of the most boring words in finance, structure and taxes, and people might wonder, why does that matter? Two equal investments, private credit and real estate, both could return 16%. Real estate could be on a net basis 16%. Private credit could be as low as 4% if you're a taxable investor. Why do you think people are not aware of that, and what needs to happen for taxable investors to understand the post-tax implications of their investments?
Well, all the reporting you see out there is on a pre-tax basis, because post-tax reporting is extremely complicated because it depends on the individual's residence, the character of the rest of their income. So it's a very, very difficult thing to even try to report on a post-tax basis. All the index and any benchmarking you're using, also pre-tax. So there's just no infrastructure out there to even report on a post-tax. And so as a result, people compare most things on a pre-tax basis, right?
I think a lot of people would be interested how Andreessen Horowitz's family office actually invests in venture. There's a lot of different philosophies there. What's your philosophy?
Our philosophy, we've built an investment approach specifically, again, for founders or individuals. So if you have, your own venture capital, I know you interviewed a venture capital person here recently. If you have your own venture capital person, right, you can construct your own portfolio. But if you don't want to do that and want to outsource that portfolio construction, you go to a traditional fund of funds. Our approach is a hybrid. The idea being that some things you need to pay others for, i.e. use the fund of funds approach. Some things you can do yourself, and save yourself the 2 and 20 headwind, right? So the hope is that when you build a comprehensive portfolio like this, boring word structuring, if you structure it properly, the pass-through fees are reduced, therefore your performance is better. And you can also build it in an evergreen way, which is another important thing, different from interval funds. Not all evergreen funds are interval funds, whereby we take care of the vintage diversification, which is very difficult to do if you're just an individual sort of jumping in and out over time.
The one thing that every venture investor in the world, every LP that has invested for more than a decade, the one thing that they say that's most important is vintage diversification. Being able to deploy over large periods of time. Why? Because all the returns in venture capital come from these best year vintages when they might have a 10, 15x fund. What are some other principles for being an LP in the venture capital space? So vintage is number one, to your point. I've tried many ways to try to analyze ex post whether I could have figured out if a particular vintage was better or not. It's basically impossible. People still persist in trying to guess. It's interesting. The other one is stage. So you want to have some of the very early stage all the way to the later stage. People tend to sort of over-index on a particular segment. So I think it's very important to have a little bit of all of it. You want to have, the next great company at a very early stage, but you also want to be sure that you don't miss the winners, right? And then, different moments in time, different vintages have different sectors that are more or less in vogue. So you have to watch by watching the vintage diversification, you do watch sector diversification to some degree, but you still want to watch the sector diversification so that you're not sort of a one-trick pony. A lot of endowments, pension funds, they tell me that they want to invest less in blind pool funds and more in structures, as we talked about. What's the evolution of co-invest when it comes to venture capital, and how does one go about actually executing co-invest in venture capital effectively? Because a lot of people get it wrong.
It's a bit of a minefield right now, I find, the co-invest space, or the direct investing, if you prefer to call it that way. I'm sure many of you here have seen there's even a nomenclature now, L1, L2, L3. There's, shell company of shell company of shell company that actually owns the underlying investment. I would just caution that, again, this is where being an institutional investor, with the proper legal diligence team and so on and so forth brings a lot of value because you have to be careful who controls those entities, how you actually get your distribution from it. So there's a lot of pitfalls, I think, there, and that's something that I think leave it to the professionals if you can.
I like to say the only thing worse than 2 and 20 is 100 and 0, meaning you lose all your money, you don't pay carry, but you're direct on cap table. Do you see a lot of family offices making mistakes when it comes to direct investing?
It's the same problem. I think people overly focus on fees. I'm not saying fees aren't important. Of course, fees are important, but look at the quality of the team you're working with, the people you hire. It's saving a few $1,000s on some fees to get a worse investment. To your point, I don't think that's a good trade. Right?
You've had this interesting but difficult challenge of building a family office from scratch and building specific asset classes from scratch as well. What have been your lessons from that?
I think one of the key things I really look for in the team, if you're hiring people to do this, go look at their pedigrees, right? It's like any service. When you hire a service person, look at what they did, look at their training. Then the hardest part of this team building exercise for me has been finding people who can wear multiple hats, who can be directly underwriting a particular investment, but then switching gears and acting as more of a fund-to-fund allocator. And without that ability to sort of switch between the two, you've sort of effectively chosen, one path only for your investing approach. And for families or individuals, I don't know why you would sort of ex ante decide to only do one particular type of approach, right? So that's the challenge, is finding people who can do both those things.
Maybe double click on that with a specific asset class. Why would you want to do both? Why not choose one lane per asset?
Well, let's just go to the real estate example again, since we've been talking about that, right? So if it was all the gross to net spread in real estate, when you include all the carry and the various fees in that space, is 500-600 basis points, right? So structurally speaking, if you can sort of do some more direct things, you can immediately capture, half of that spread. And then if you look at the dispersion in the asset class, the interquartile performance dispersion, if you cut out a couple hundred basis points, you move up one quartile easily in the performance league table. So that's why structuring and being able to go direct is so important. You don't even need to believe you're a great investor. I'd like to think my team are good at investing, but by structurally doing this, you sort of automatically guarantee yourself a better return, right?
It's much easier to get 200, 300 basis points on structural alpha than it is trying to beat the market day in, day out.
100%. Yeah.
Going back to the strategic decision to build a family office that breaks even, why is it so strategic for Andreessen Horowitz to have a family office?
Well, I think you want to be in front of, and you want to stay. The whole philosophy of Andreessen Horowitz is it's a community. You work with the founders from day one. You help them grow the company. Why should an IPO or some exit be sort of an artificial end of a relationship? It's the beginning of a new phase of a relationship. And these people are going to go on to do many great things. I don't need to sort of remind you how many serial entrepreneurs have done fantastic things. And so keeping that community tight-knit is a highly strategic advantage.
Mark Andreessen, Ben Horowitz, and the team talks about this ethos of Andreessen Horowitz. Have you found that to be true, being internal?
Which part of the ethos?
Just the founder-friendly and this focus on the founder.
Oh, yeah, absolutely. I mean, that's why exactly to your question earlier, really a focus on break-even, an obsession with providing absolute best-in-class support to founders in every way, shape, and form. If you can take this sort of concern off their hands of like, how do I deal with all this crazy, complicated trust, estate, tax, portfolio construction stuff, if I can trust that someone really has my back, I can focus more on my business and actually focus on things I love instead of being distracted by these things. So it's a very deeply held ethos, and it's exciting to be part of it.
Preparing for this fireside chat, I talked to probably half a dozen of your team members, and I found something fundamentally different about them. And they're not the traditional wealth managers.
I hope there were good things you found.
Almost all positive. And why is there such a standard in the wealth management firm where people are salespeople? Maybe you could double click on why that's the default.
It just comes from where they came from typically. So most wealth firms are spin-outs of the big banks, right? And the big banks have centralized the asset management piece of it, here in New York often. Whereas the wealth teams are focused on raising assets. So when they spin out, they obviously don't get to keep the central investment resource. And so that's the DNA of many of these places. Right?
And a lot of the wealth management, as I've gone down this rabbit hole, I learned that a lot of these wealth management firms actually came from the brokerage business. They weren't actually investors. They were before selling financial products and then became wealth managers.
Yeah, and it's interesting. We have many clients that share us with these other firms, and it reminds me a little bit of in the 80s, the brokers would call up my dad and on the phone say, hey, it's time to buy IBM stock, and my dad would say, sure, And you still have a bit of that DNA where you see like every month or two, some cool thing is proposed to the client, as opposed to, again, a strategic decision around how do you build out your asset allocation, here are the different components, and then let someone else sort of do that for you. It's very much a sort of a piecemeal approach.
Speaking of dogmas and principles, in the institutional world, it's also has their own dogmas and their own beliefs. What are some beliefs that institutional investors have that you just believe to be plain wrong?
So you hit on a word. I don't like dogma, so to your point. What's so refreshing about the family office world is that you don't force yourself to these dogmatic limits. So for example, many institutional investors will say, hey, I can't consider a manager unless they have a 3-year track record, and the 3-year track record clock starts when they have, I don't know, $500 million under management. So the person could have been in business for 15 years, knocked the cover off the ball. They barely reached 500 million this year. You sort of say, sorry, I can't talk to you. So there's a lot of these dogmatic things like that. The other dogma is, you often find is, all market knowledge, all watching the market, macro, everything. I outsource all that to managers. It's not my expertise. I shouldn't opine on this kind of stuff. And in fact, I think that's wrong. You should be aware of that, and you should try to position your portfolio at least somewhat. I'm not saying you're building an in-house hedge fund.
You're not supposed to play a macro investor, but sometimes it doesn't.
But if you are not playing macro investor, you may have, for example, missed this AI, or you catch up late because you thought, well, that's not my problem, right? But in fact, it's a huge change, and you should have maybe tilted into that a little bit.
Another example may be large buyouts today. There's just so much dry powder sitting on the sidelines, and now there's tens of trillions of dollars from retail coming in, and you're supposed to take this view that, well, we're not supposed to look at that, the inflows and the current pipeline and the dry powder. We're just supposed to ignore it and just dogmatically invest.
Not only that, we're going to look at the trailing 20-year track record of a 600 bip spread, and I'm going to assume it's the same going forward, right? Really? Like maybe, what if it's 200 bips, right?
I've interviewed close to 400 now, GPs and LPs.
Congratulations, by the way.
Thank you,
Yeah.
Thank you. And you're the first one to throw stones at this idea of diversification and the endowment model diversification. Tell me about that, and why are you so against it?
Well, I'm against over-diversification, right? So if you end up with 300-400 managers and hundreds of positions, you've just built yourself a very expensive illiquid index, right? So go look at the performance of many of these endowments and foundations versus the 70-30. You can buy the 70-30 at the brokerage of your choice for peanuts. And sometimes they don't outperform, or they barely outperform, except that they're completely liquid, fee-laden, not flexible, so they can't take advantage of changes in the markets because of the fact they're illiquid. So, there's definitely such a thing as over-diversification, right? I mean, venture proves it, right?
There's a pension fund in Nevada that one person runs it, basically all passive. I think he's been top quartile for like 19 out of 20 years.
Really? You should interview him.
He does not want to do it. He's low-key.
Yeah.
To your point, Professor Steve Kaplan, University of Chicago researcher, famous in the space, he claims that institutional investors, non-taxable investors, should not really invest in infrastructure or real estate because they're inferior asset classes to other risk-adjusted returns. For taxable investors specifically, are there certain asset classes that taxable investors should just not have in their portfolio?
I mean, it's hard to make blanket statements, but for example, high turnover strategies that generate a lot of short-term gains, like hedge funds, you have to be careful, right? And the hedge fund industry, by the way, has become aware of this. As you know, a number of hedge funds have launched now tax-aware strategies exactly to address this problem.
Why? I think tax-aware has grown from 10 billion to 150 billion in 24 months. Why? What's the reason for this meteoric rise in assets?
A lot of people are sitting on massive capital gains. The tax-aware sort of indexing you're talking about generates capital losses, right? So if you're sitting on a big capital gain and you don't want to necessarily pay tax today, you sort of defer the tax. It's very important. These are not tax elimination strategies. They're tax deferral strategies. So you can defer the strategy.
But these could be 500 basis points, 1,000 basis points, even more in terms of yearly kind of structural alpha.
Yeah, and it's repeatable because it's structural, so you don't have to sort of worry the way you do about managers, whether will my manager do well this year or next year. This requires no manager skill per se, except operational excellence on the execution front.
Is that the new benchmark? And institutional investors would benchmark S&P 500, MSCI. Is the tax-aware equivalent of that the new benchmark? And if not, why not?
100%. I think for a taxable individual, you should not simply look at S&P 500 or S&P 500 total return. You should look at tax loss harvested S&P 500, which is several hundred basis points better and makes the job of an active manager just that much harder. As you know, most managers don't beat the benchmark historically on average. And by increasing the benchmark with this systematic tax alpha, you've made it that much harder for professional investors to beat it.
There's two narratives in the family office space and asset management in general, which is size is the enemy of returns. This is a dominant narrative. But now there's this new narrative, which is economies of scale of capital. Sometimes having more capital could lead to better outcomes. As a family office investor specifically, how do you reconcile these two narratives?
No, I think there's sort of a U-shaped curve, upside down U. I think you need to be big enough to influence and negotiate. And give you an example, some of the tax loss strategies that are done out there, you can customize them in a lot of ways if you have enough capital. But to your point, when you start sort of having a minimum check size of 100 or 200 million to sort of make your sort of operations manageable, that's the real reason.
What's the AUM? So if you back into that, what's the AUM? What's this Goldilocks AUM that you want to have as a family office?
20, 30 billion, something like that, I think. So I think a lot of family offices, so how do you define family office? Question number one. But if you have $1 billion or $2 billion, very difficult, I think, to run a single family office with a multi-asset class investment mandate, right? Many single family offices that are that size do very well, but they focus on one asset class that the principal happens to know, right?
I've asked this question of so many family offices, a lot of the wirehouses and the large multifamily offices. What is family office services?
What is family office services?
Yeah, what does that even mean?
It's vague, I think, on purpose, right? But it includes everything from nannies and dog walkers, right?
That's what they all say, we'll walk your dog.
Yeah.
And then I ask, literally or figuratively?
Literally.
Okay.
Literally.
But outside of walking your dog,
my question to you is, why are you paying AUM fees for someone to walk your dog, right? The analogy I always use is if you had your car repaired and the mechanic comes out and says that'll be 10 basis points of your balance sheet, what would your reaction be? I think you'd sort of say, what are you talking about? It should be a flat fee, right? Services should be flat fee based, right?
And what are smart family offices? What are they looking for from a family office in terms of services? What is actually worth the money?
You mean when they outsource to a multifamily office? I think it's specifically services around, because the word service is so vague, right? Services around investing, so structuring, legal diligence, sub-doc population, those kinds of things, account opening. Those things are highly valuable because they're difficult to do. Finding a nanny or a dog walker, I don't think that my team is any good at that necessarily, right? I wouldn't trust myself to find a nanny. Right?
Maybe you invest in the startup that does that, but you shouldn't be doing it yourself.
Or you go, there are companies that do that professionally. Go figure, right? So.
I'm not going to ask you a generic AI question, but at the same time, the tools, the fintech tools for family offices are growing at an epic pace.
Yeah.
Every week I get pitched a new product or some kind of version of this. What are you most excited about for tools for family offices?
It's really interesting. We use a lot of this on our team, but I would sort of separate into sort of the vibe approach versus the sort of expert approach. So the vibe approach is you tell your chatbot, you say, hey, is this a good investment, right? And that's when it's prone to making stuff up and hallucinating and all that. The pro approach is take this LPA, here's 350 keywords that I've quoted. I want you to pull those 350 keywords, put them in a database. I then want you to make these calculations where I'm going to actually put the formulas in, and you can sort of map out the analysis you used to do in a spreadsheet down to the equations inside the tool, right? And now you've automated your analyst, right? And I think that the sort of the mistake people make is they think that asking, is this a good investment, is equivalent to building all that infrastructure in-house. But
understanding the nuance to what you're actually looking at.
Yeah.
Professor Ilya Strubala from Stanford, he does this research on LPAs, perhaps even more boring than structure and tax. But he actually figured out that the fees are not the things that drive the returns, the fees and the carry. It's actually fees in context of what? What are the 2% fees on what period? What is the 20%? What is the hurdle? All those details, that's hundreds and hundreds of LPAs, that actually drives returns.
That's right.
When all the returns being equal, that actually, the nuance is
right.
the thing.
And so therefore, if you just ask, Claude or your favorite thing, is this a good LPA? How is it going to know? You have to say, what's the catch-up? Is it a 50% catch-up or 100% catch-up? So on and so forth. Right?
What is it going to take for the asset management industry to take the taxable investor seriously?
I think it's already happening because it's the next great hope, right? For a lot of especially in the private asset classes, everyone is racing to raise assets from those people, in part because I think the institutions are sort of tapped out, might be the wrong word, but they just are like waiting for DPI. So it's the fact that the next place they have to go is going to force them to confront the taxability.
They have to go there. I think today 95% of all retail capital is going to 5 funds. 5 private equity funds on the planet.
Which ones?
We'll leave that for the next conversation.
I was just putting you on the spot, sorry.
Well, Michel, thanks so much for jumping on Fireside Chat.
Thank you.
Looking forward to doing this
Appreciate
again soon.
it. Always enjoy it.